The Bank of England sets interest rates at midday UK time on Thursday the 14th of September. With the recent rise, a gain in inflation but a slightly lower print in average wages, despite the UK economy apparently creating more and more jobs, should we be preparing for higher base lending rates? Well, Paul Hollingsworth, UK economist at Capital Economics, joins us now. Rates at 0.25%. Do they need to rise? Are we expecting anything from the Bank of England this week?
I think definitely not this week. I think the chances of a rate hike now are extremely low. Certainly there are still some hawkish voices on the MPC. We're likely to see a split vote. There are a couple of members that are currently not happy with the level of inflation. It's considerably above the 2% target. However, the majority of the MPC, I think, are still going to be quite concerned about the strength of the economy and also the lack of any wage pressures at the moment that we're seeing.
The two you're commenting about is that Michael Saunders and Ian McCafferty, because they seem to be the people that seem to be the most hawkish on the committee at the moment.
Definitely, and I think we saw a recent speech in which Michael Saunders definitely sort of laid out his view and did suggest that he was preparing himself to again vote for a rate hike at this meeting.
But he's talking there about a modest rise. What is a modest rise in the context of where we are? Because we're at 0.25%. If you add back in the cut that we saw last August, that would effectively double base lending rates. Is that the sort of rise we should be expecting as and when it happens?
Yeah, I think my impression anyway is that the hawks are advocating just a reversal of the emergency cut that we saw back in August last year in response to the Brexit vote. So really we're talking about rates going back up to 0.5, still an extremely low level by historical standards. You know, the economy is still going to be getting quite a lot of support from monetary policy. So I think at the moment they're just advocating that one small rise, perhaps see how that goes down with both the markets and the economy before embarking on a more prolonged period of interest rate increases.
Every economist I talk to, they talk about Brexit all the time. I think that's one of the big things that's occupying their mind. And in fact, Michael Saunders even referred to that. He said that we should expect a bumpy ride, nonetheless, a rise in interest rates. What is a bumpy ride? How is it going to affect us all?
I think we can expect quite a lot of volatility in the growth figures over the next few quarters. So there might be a couple of quarters where we have quite weak growth. I don't think that Michael Saunders is expecting a recession in the UK, but I think we can expect growth to remain a little bit sluggish over the coming quarters as we see consumer spending still squeezed by that fall in real earnings. But I think the MPC, rather than responding to any bumpiness in those growth figures, they're really trying to look at what's really going on, what's the underlying growth rate of the economy, and the key point is what's happening to inflationary pressures that are driven by the domestic economy rather than just imported from the drop in the exchange rate.
Well, let's take a look at the exchange rate if we can. This is sterling against the US dollar, and bring up this chart. Here we are now, well off the lows. I think we've just had a print which takes us up to a one-year high against the US dollar. We've had lows around about 120. Here we are now at 132 or 1.32 to the dollar. Clearly a lot of imported inflation when sterling was very much lower than where it is now. Why is inflation still rising when we've got this uplift in the value of sterling, not just against the US dollar but also fractionally as well against the euro? So presumably ultimately this could well see some lower inflation figures printed as we go into the back end of this year.
Well, it typically takes quite a long time to feed through. So what we see is the initial impact of the drop in the exchange rate is on firms, it's on producers. They might decide to absorb that increase and take a hit to their margins. So there's obviously an impact then on what they eventually sell, and then those selling prices, they take time to feed through into the shops. So we're not going to see the impact of this most recent move in the exchange rate this year. It's likely that what it means is that inflation will perhaps come back down a little bit quicker next year rather than impact now. And we're still likely to see, I think, inflation pick up a little bit further from where we are now. So we think it'll peak at a bit above 3% in October, but after that it should start to fall back down towards the 2% inflation target. But it is likely to remain quite a bit above that target throughout most of next year.
But if we have a rise in interest rates, is this going to curb that sort of inflation? Because, as you say, much of it is imported pricing.
Well, certainly if we do see a rise now, or in the near term at least, I think that would be more hawkish than the markets are currently pricing in. So we probably see some upward impact on the exchange rate there, and that could definitely lower inflation outlook over the next sort of year or two.
Where do we go from here in some of the big picture commentary I'm hearing about what's going on in the financial markets? I know that the City of London is a big motor for GDP. We've got MiFID II coming up at the beginning of next year. That apparently is going to disrupt some bank profits. Do you see the UK having a hit on that? Do you see anything else that's coming up which could well give us a hit on any aspect of the economy, which might actually begin to bring the hawks back into line with the rest of the MPC and suggest that 0.25% is actually the rate we should have for the next year or two?
I think we're at a bit of a turning point at the moment. So one of the conditions that Governor Carney set out for him voting to raise interest rates is that we need to see some signs that business investment and net trade are helping to offset the slowdown in consumer spending growth. Well, at the moment, we've not seen that. We're seeing net trade growth still very weak, primarily because import growth is very strong, and we're seeing business investment pretty subdued as well. Now, looking ahead, the survey measures of both exports and business investment are pretty strong. So if we do start to see a pickup in the actual figures over the coming quarters, and we do see those components of demand helping to offset the slowdown in consumer spending, then I think we might see some more hawkish signals coming from some of those MPC members. But we will need to see some actual evidence of that over the coming quarters.
OK, so from where we're sitting now, here in September, when do you think is the best case potentially for the Bank of England to start looking seriously at raising interest rates?
I think they're likely to change interest rates given how historic it would be. Any rise in interest rates is likely to come alongside an inflation report. That would give them a press conference in order to explain that. So I think we're probably looking at February or May next year as being the most likely time to raise rates. That will partly depend on whether we do now see that pickup in wage growth over the coming months. Our view is that they'll probably remain quite cautious, and so our central forecast is for a rate rise in May. But certainly if we do see more evidence of wages picking up and domestically generated inflation rising over the second half of this year, then we wouldn't rule out an earlier hike than that.
Yeah, and the QE, because we're hearing about the Fed starting to repay back their balance sheet, we've got a balance sheet enlarged by a relatively modest QE here. Is there any hint at all the Bank of England is wanting to adjust that?
I think it's going to be a long way down the line. I mean, previously, the bank has suggested that it wouldn't be until rates reach 2% before they start thinking about unwinding QE. That's the guidance that we currently have. They've not mentioned much else on that. I know Ian McCafferty more recently has suggested that they might want to think about unwinding QE perhaps a little bit earlier than that. But generally, I think that it's going to be quite a bit further down the road than, say, the US.
OK, all right, Paul, it's a pleasure. Thanks indeed for joining us. Paul Hollingsworth is UK economist at Capital Economics with his view on the Bank of England. Midday UK time on the 14th is that decision, that latest decision from the Bank of England on interest rates, but also looking out there with Paul into 2018.